Good afternoon, ladies and gentlemen, and welcome to the ZOTEFOAMS results for the year ending 31st of December 2020. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen. Just simply type in your question in the box and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so. These will be available on your Investor Meet Company dashboard, and we will send you an email to notify you when they're ready for you to review. I'd also like to remind you that this presentation is being recorded. Before we begin, we would like to submit the following poll, and if you could give that your attention, we'd be very grateful. And I'd now like to hand over to David Sterling, CEO, and Gary McGrath, CFO of ZOTEFOAMS. Good afternoon.
Good afternoon, everyone.
Hi there.
Hi. Gary and I are going to go on, take our videos off for the duration of the presentation to allow us a bit more focus. I know we're distracting people with our handsome good looks and use of bandwidth. So we'll do that and jump into the presentation. So before we start, it would be just interesting to note that 2021 is the 100-year anniversary of ZOTEFOAMS. We haven't been called ZOTEFOAMS for 100 years, but certainly the predecessor companies and the technology was first developed 100 years ago by a chap called Marshall, who was worked alongside Thomas Edison, the famous inventor from the USA. And I think we see here a picture of, I believe, Mr. Marshall with a tube of foam that he invented by putting nitrogen gas in a pressure vessel. Things have changed a lot since then. We'll give you the latest updates as we go through, but it's a pleasure being with ZOTEFOAMS in the centenary anniversary. As we move through the presentation, we will cover a variety of subjects, but where I'd like to start is that just to remind our audience that we think about our business in really three separate divisions: polyolefins, high performance products, and MEL. Polyolefins and high performance products both utilize our unique autoclave technology, with polyolefins being made from common polymers such as low density polyethylene in a very wide variety of uses in markets worldwide. Our high performance products are made using the same technology, but start with higher priced and polymers with certain specific attributes, often around energy return for footwear or fire performance for aviation, etc. And these are typically designed around those key attributes for specific markets and offer higher margins and, we believe, higher growth opportunities ultimately. Our T-FIT insulation products are made from some of our own high-performance polymers and are disclosed under our HPP segment. And MuCell technology is putting bubbles in a molten plastic stream and making extruded parts using higher gas content and lower polymer content than a solid plastic. Fundamentally, it's used to reduce plastic content in common plastic articles such as mainly consumer packaging, signage, automotive ducts, etc. But we've also adapted the technology recently to make something called resource packaging technology, and I'll come on and explain about that later in the presentation. Our basic strategy is to use this unique technology to create differentiated products, to focus our efforts in the areas where we think these differentiated products will offer the biggest benefit and allow us to be the market leader. And it's primarily an organic growth strategy, although we do occasionally think about acquisitions or bolt-on technologies or partnerships. Largely, we have made our own way in the world, and we see that as core to our being. The technology we have is pretty flexible. The product range is quite wide. The range of applications we operate are varied, both in market types and geographically. And that variety, that flexibility allows us to put our resources into different markets where needed, and to realign the business if one part of our markets are not going so well. So really that's the story of 2020 and the COVID pandemic. As we go through the business, we will see how the business has developed in 2020. Before we do that, however, I do want to talk about sustainability. It is definitely becoming more and more of a key driver of decisions globally. I think in many industries and government, etc., and in our personal lives. And in ZOTEFOAMS, we are considered by many to be a chemicals company. We are known to use plastics, both of which bring us under the spotlight of sustainability, potentially initially, I think, with some sort of negative connotation. But we actually at ZOTEFOAMS think the opposite. We think that we use foaming technology to create very lightweight materials that actually are beneficial to society. Our products are made for long-term use. They are designed for permanent or semi-permanent solutions which reduce weight, improve insulation, protect goods, protect people in applications such as medical or aviation. And therefore, we do believe that where we focus our efforts, that our foams are the optimal materials. And with our resource and MuCell technology, we are looking at solving some fairly intractable problems to reduce plastic and improve recycling. So, and the way we think about this is we look at how we develop our business, and in product development, market development, consider sustainability as a key component of, is it going to be good for society? Is that business going to be there long term? And we focus on improving our operating efficiency internally in the way we make foam, the amount of material we use, reduction scrap, reduction of energy. And to this end, we are adopting the TCFD reporting standard for sustainability. And the information under TCFD will be available in next year's annual report. So if I move through the business structure and shape, oh, sorry, one more slide before then, just highlights. It's quite interesting if we look at the results, just as results, what we see is that revenue is broadly unchanged, up a little bit. Our cash generated from operations is up a bit, but not materially different. Our operating profit is very similar, and our earnings per share very similar to last year. And you would think, if you didn't know the history or the background, that that's been a fairly serene year, that management have just sat and kind of nursed the business through 12 months. And in fact, I would say the opposite is true. We've had some pretty wild swings in our product mix and our business, a lot of challenges to deal with. And if we look at how we've ended up, I'm really pretty pleased at the performance in the year. Our high performance product sales were up 13% and now represent 36% of group revenue. The polyolefin foam sales ended pretty similar to last year, and in markets that have aviation, automotive, industrial, that were well down on the previous year, was supplemented by creating a market for PPE, protective equipment, which filled that gap and led us to a broadly neutral result in polyolefin sales for the year. Our MuCell extrusion business was hit hard. We sell equipment as well as get licensing fees, and the equipment sales dried up completely, as they are more or less a discretionary item for a lot of our customers. And certainly our staff weren't able to travel and promote our business and help our customers, embed equipment in their processes. So the COVID restrictions really hurt MuCell in the year. With all these things going on, we actually delivered a record 6-month period in the second half, and overcame a fairly tough, large decline in sales in the first half to get back to that 2% growth in the year. I think the year-end debt ratio was similar to last year, about 2.1 times earnings EBITDA, down from 2.6 at mid-year, which is a really good performance. During the year, we didn't raise equity. We took some government support, which was fully repaid fairly quickly in the second half. We did suspend our final dividend last year in the peak of the uncertainty of COVID, but brought back an interim dividend and have an increased final dividend compared to the last time we paid one this year. And I think ended up in quite a good position in a very difficult year. The story of the year is illustrated by the chart you see in front of you. Revenue by business unit in the top right, we've talked about in the previous slide, but on the left-hand side, what we see is revenue by geography, with the rest of the world and the UK substantially higher proportions of our group revenue than they were in 2019. And the rest of the world predominantly driven by growth in footwear, and the UK growth predominantly driven by the PPE sales. The hardest hit area was continental Europe, which is predominantly Azote business, and quite a marked fall there. And if we look below that revenue by industry, we can see the same picture: sports and leisure well up, product protection, which includes a lot of industrial applications, predominantly in Azote, well down, and medical PPE well up, and transportation, which is aviation and automotive and a little bit of railway, again well down. So real swings and roundabouts in the year, difficult to manage both geographically and product mix through the plant. We've had to reallocate resources frequently and reprioritize frequently during the year. We managed to get through the year not making any redundancies. We actually increased our headcount towards the end of the year to deal with the record second half, and we started 2021 in pretty good shape. So before I talk about that in much more detail, I'm going to pass over to Gary to cover the financial slides.
Thanks, David. So as David mentioned, group revenue was up 2% in the year to 82.7. And indeed, H1 revenues were knocked severely by COVID, and they came in at 34.6 million as we reported in June. That 34.6 million was 18% down on 2019. But the second half was 48.3 million, and that was 25% up on the equivalent previous period. That revenue translated into gross profit of 27.8 million, which was 800,000 down on 2019, and translated into a gross profit margin of 33.6%, which was 180 basis points behind the previous year. So that was a mix of a number of items, some of them positive, but offset by more negative. On the positive side, footwear sales were up, and they have an average price that is superior to the group's average sales price. So that certainly benefited, as did lower raw material costs through the year, and they actually reached the lowest point back in about Q3 last year. In addition, and we've mentioned this on a number of our trading statements, we were able to flex our manufacturing costs quite successfully. We do bring in some degree of indirectness to the direct labor cost, because we use agency staff to help flex and deal with ups and downs, as well as overtime. And obviously during H1, when activity was much lower, we were able to reduce that cost quite noticeably. Offsetting those benefits to profit margin were firstly the fact that we had the azote volumes. We actually increased azote volumes in 2020 by 7% versus 2019. But much of that was driven by, a big element of that was the PPE contract, and that although the volumes are very high, came in at a sales price which was below the average price for the group. So consequently, had a negative impact on margin. In addition, lower ZOTEC aviation. David mentioned 54% down in aviation in the ZOTEC F business, and that is one of our highest margin businesses, so consequently also depressive of margin. And finally, 2020 saw the full operation of our UK investments. We'd invested through 18 and 19 in high temperature, low pressure vessels in the UK to help service the HPP growth, and they were on full. And we also had the full year impact of the second high pressure vessel from the US, consequence of which was an additional £1 million to depreciation. Adjusted profit, operating profit was in line with 2019 at 9.4. Just a reminder, we adjust for the amortization of acquired intangibles, and it's not a particularly large number. In 2020, it was £260,000, and in 2019, it was £280,000. With that adjustment, like I say, the operating profit was in line at 9.4. And the reason that we were able to play catch up there from the gross profit position was SG&A, and fundamentally distribution costs, where we have our sales, our travel costs for the sales teams, our marketing expenditure primarily, which obviously was severely impacted by COVID. In addition, where and this applied across the range of SG&A, where people left us, we made very clear decisions as to whether that was the right time to replace or whether we should hold off for a while. So consequently, that was the distribution cost. On the administrative side, actual admin costs actually increased. If you ignore FX just for the time being, admin costs actually increased by about 1.5 million, and that was almost entirely the net impact of the hirings of the previous year having a full 12-month impact. But offsetting that was FX. We had a fairly neutral FX year in 2020. Not the currencies moved up and down, but over the average they were fairly consistent. But the previous year had seen us take a 1.2 million charge to that admin line. Consequently, that not happening offset the increase, so that admin was actually neutral. But nevertheless, distribution, sales costs, etc., helped keep operating profit in line with the previous year. Adjusted profit before tax was down 400,000. That difference is entirely due to finance charges. In 2020, that charge increased to £900,000 from the previous charge in 2019 of 500,000. However, on top of that finance charges are finance-related charges that you don't see in the P&L, that's capitalised, and they're in relation to the capacity expansion projects. And in 2020, that was entirely related to Poland, with everything else being on stream by then. The tax charge, £1.1 million, or an effective tax rate of 13.7%, which is below last year and below the corporate tax rate for the UK. We're generally below the corporate tax rate because of our R&D credits that we're able to claim annually. However, in 2020, we also had the benefit of booking overpayments from previous years. So that has a one-off impact. We would expect to return to more normalised levels in the future. Adjusted EPS was in line with last year, as David mentioned, at 15.33 pence. And final dividend, we suspended the dividend last year. Obviously, this time last year, we all know where we were. That was a prudent decision to make. We took that. We did, however, reinstate dividends back in October for the interim, having repaid the very small amount of furlough monies and other government support that we've received. And we're now continuing with that and the 4.27 represents a 3% increase on the last paid dividend, which was for the 2018 financial year. And just a reminder, really, we make reference to before exceptional items here, and we didn't have one in 2020, but we did have one in 2019, and that was pension related, and that was in relation to a credit that we received in relation to a successful claim against our former advisors to the defined benefit pension scheme. And that's in relation to the fact that the linkage to future increase in salary had not been broken. So back in 2001, we closed the scheme to future employees. And in 2005, we shut it to future accrual of service and salary. We discovered that indeed the future accrual of service had been broken, but the link to the salary had not. And we were able to successfully claim 1.05 million as a consequence. Moving on to the statement of cash flows and debt liquidity position, David made reference to it. Well, our net debt under bank definitions is 34.2, which was down slightly from the half year, but up against previous year as we expected. Why bank definitions? That's the number that we use to calculate bank covenants. What it does, it's probably only about $1 million off IFRS version. It relates, and what we take out is IFRS 2, which is stock options, and IFRS 16, which is finance leases, for which we have relatively few. So the net debt to EBITDA ratio 2.1, down from 2.6 at the half year, but it was 2.0 this time last year. Very comfortably below the bank covenant of 3. And liquidity has remained pretty constant throughout the whole year. I think we started the year with 20. We had 19 at the half year, and we started at 19. We had 20 at the half year, and we're back at 19 for the end of the year. In terms of cash, but in terms of performance, we are a cash generative business, and cash generated from operations was up 10% to 13 million. And that's very much driven by effective cash management, cost management factors that I've explained previously when discussing the P&L. Working capital was well managed through the year. I think receivables particularly happy about. I think the very fact that in a very difficult year we actually reduced our receivables is a sign of the strength of the business and the importance that our product is to our customers, and therefore the importance of them paying to make sure that we continue to work together. In addition, we had quite a lot of focus on it in my team in terms of recovery of debts and so on. And indeed, for the last 6 months of the year, we averaged below 0.5% of overdues, which was a quite considerable achievement. Offsetting the receivables is inventory, and that both inventory and payables actually reflect the 2021 expectation. So consequently, it was a fairly when we started last year, we'd had a Q4 2019 which was pretty difficult, so activity wasn't extreme. But as we've entered Q1 2021, there's a lot of activity going on, so it's important to make sure that the high performance product raw materials were in place. And also, of course, Brexit uncertainty, we just made sure that in certain areas we had the contingency there, particularly in our AZO business, which all comes from Europe, to make sure that we weren't caught short in the first weeks of the year. And finally, capital expenditure down from a historic level in last year of 25 million, where we had a number of our expansion programs underway. By 2020, we were down to just Poland. We spent 7 million of the 13 on Poland. An element of the rest had already been committed to by the beginning of the year, and certainly by the time we hit March and the pandemic spread. So after that, it was very, very little, and we took quite considerable action there to manage our cost position. And the Poland plant is now operational since February this year. With that, I'll pass back to David.
Okay, on to the business review. I'll run through these fairly quickly. Overall, we saw the subdued demand at the back of 2019 continue into the first part of 2020, and then we're hit by COVID. So it's been a year where demand's been all over the place. As I said, we have really reorganized and realigned our business around the areas where we could see growth and new opportunities, market share, etc. So the traditional markets of industrial, automotive, aviation, marine, all down by more than 30%. PPE, footwear, teeth insulation saw growth, and the shape of the business changed quite a bit in the year. If I look specifically at polyolefins in azote, even though the segment revenue was at similar levels, our profit has declined in the year as we've been carrying more costs in the year, and some of our premium azote business, such as aviation, declined as well. But the main reason is we have built capacity at a time, and it's coming on stream at a time when the markets are depressed. So having that underutilized capacity and asset gives us a heavier overhead burden than we would normally have expected. And because azote takes up the bulk of our capacity, it gets burdened with the bulk of the overhead in the business. So we've seen that margin shift. We did see slightly lower polymer prices in 2020 than in the previous year. That helped a bit. And I think, as we mentioned before, the key to margin enhancement in this business is, number one, asset utilization. So that is our primary goal in the short to medium term, is to get the asset utilization up, and that would ultimately drive azote margins. Although, as Gary said, we have got Poland coming on in 2020, and that will give us some non-cash depreciation costs in there, and also some operating costs of a plant that's currently running at one shift and won't move to two shifts until later in the year. Our high performance products is a range of different materials, but predominantly it's footwear and aviation, with some technical insulation and T-fit. First half, we actually saw a decline because of the aviation business of 7%, with a 32% growth in the second half. And the margins on this, as you can see, very much higher than the azote business. Takes up disproportionately less capacity, but the reality is that these are higher priced, more technical materials and capable of generating higher margins and higher growth rates. Footwear has grown from 16% of group sales to 26% of group sales in the from 2019 to 2020. So it's been a very significant success and a very significant driver of our business growth and margins in that period. Fluoropolymer sales, as we've said before, substantially linked to aviation, and that is a market where demand is just very low at the moment. I'll talk about the future when we come on a bit later. And T-fit is our insulation product, which is sold into biotech, clean room, food processing, all of which generally are areas which are unaffected or not hugely affected by COVID in terms of demand from the markets. And that's what we saw in China. We saw a 60% increase there because the Chinese market was operating as normal and they're building factories. Whereas in Europe, even though the demand for the products are there, they've not been building the facilities because they couldn't complete them due to COVID. So a lot of postponed capital expenditure there, leading that market to decline by about 40%. And there's been some destocking through the supply chain in that as well. Whereas India, which we'd expected to grow quite healthily and has got a very big potential for these products, was relatively flat, caused mainly by good demand, underlying demand, but inability of people to get projects moving again because of COVID delays. The margin here, even though it's much better than Azote and has improved, has still got potentially some way to go. The reason for that being that we have early stage products in our HPP portfolio, which are, of course, costing us money and not contributing yet to the revenue line. So that's a portfolio margin, and as the portfolio matures, we have got opportunity to grow that, subject to the overhead allocation of the business. I've just had a question in from Simon C, which is specifically relevant to that comment, so I'll just pick it up right now. It's saying, what do you see as the addressable market for T-FIT, and where's it being used, and footwear visibility. So I'll start with footwear. We have an exclusive deal with Nike. We work very, very closely with them on their priorities for the upcoming 2 or 3 years. So we've got pretty good visibility going forward. Nike themselves obviously are forecasting how many shoes they would sell of which particular model, and so it's not a precise number, but certainly they've been pretty good in the past at giving us reasonable estimates of where our demand's going to come. And I think we see 2021 as a continuation of the second half of 2020. So that footwear demand year on year should show a nice positive growth story. As far as T-FIT, we are targeting things like biotech, pharma, food processing, and if you look, over the press releases and annual reports from ZOTEFOAMS, you'll see they've been used in Coca-Cola juice processing, Pfizer, people like that, as well as semiconductor processing. So we are an expensive solution. I make no apology for that, because we're the best solution on the market, we think, and the people buying it obviously think so. But it does take quite a bit of education with the end users about how the whole life cost benefit analysis can be done. And the types of people that we're engaging with are people who are building facilities, like the construction contractors. Sometimes it's the operator themselves. It's the Pfizer or the Glaxo, and sometimes it's insulation contractors who are recommending how to insulate pipes in the clean room environment. So we have seen a good demand pipeline from, for example, in China, vaccine development. They're talking to us because they want to get up and running quickly. And in China, they're talking about building an entire vaccine plant in 12 weeks. I don't think we would get the planning permission to do it in 24, 36 weeks, never mind to build a factory, but that's what they're talking about. And our insulation solution is very conducive to quick working as well as effectiveness. So, but ultimately we want to drive the business into the food and beverage market, because it's such a big market compared with the clean room market. So that's something that we're working on as we go. Moving on to MuCell, as I explained earlier, MuCell revenue comes from equipment and licensing. Equipment is down because it's difficult to get out to the customers. Licensing broadly stable, and with the lack of travel, the operating result has been the same. MuCell, I think over the years, has been a little bit of a frustration, because there's been a lot of potential there and it's never quite caught in the market. And although a lot of people are interested in it, it does seem to be, for many people, a discretionary idea or a discretionary spend to try to put equipment in to reduce their plastic content, because of the way the market's structured and the expectation that those savings will be passed on to their customers. So in some cases it's been extremely successful, and we are seeing large licensees still interested in MuCell, and some of the licenses we signed are starting to, reach higher levels of license royalty payable, etc. But one of the things that we have done over the past 18 months or so is to kind of move more of our focus on MuCell across to our resource technology. I'll talk about that. I've got a specific slide on that later, so I'll leave that until then. But that's extremely interesting prospect. So in terms of strategic progress, cover three things. One is just the markets we're in. Where do we see the growth coming from? Well, with the Poland plant now committed, the Poland plant now finished, that ends the kind of capacity enhancement commitment. That plant is well placed to serve particularly the azote market in Central and sort of German region of Europe. And as the HPP business, footwear, etc., grows, that uses the capacity in a UK facility. And as that capacity is used up, we will increasingly serve the markets in Germany, etc., from our Poland facility. Footwear is now 26%, as I said, of group revenue. We can see that increasing going forward. The footwear sales, I would hope that the rest of the business would grow significantly as well. So we wouldn't necessarily see the percentage increasing, but certainly the absolute value of footwear. It's been a very successful collaboration with Nike, and as I said, we are deep in with them on their priorities for sustainability, innovation, and cost and efficiency. Through 2020, we did prioritize development on certain areas that were more longer term in nature, aviation and automotive in particular, e-vehicles. And although we don't see those really generating huge benefits in 2021, there's an awful lot of activity right now as basically the aviation and automotive guys had cut back on their development for the duration of COVID. And they're now playing catch up with some fairly tight deadlines and fairly big projects to deliver. So I think we did the right thing. I think we're well placed there, but that's not something necessarily that's going to show through in 2021 and more like a 2022 type impact there. We have, again, looking at sustainability, developed recycled foams with internal process scrap and polyolefin, and we're looking to extend that to some of our HPP products. And I've talked about the ground transportation, e-vehicles, trains, etc. Again, an awful lot of work being done, and it feels like this is a good opportunity set for our lightweight and high performance materials, particularly around fire and temperature performance. And we've invested quite a lot to develop resource. I've got a slide on that, so I'll come to that in a minute. In terms of capacity, the major capacity investments are now complete, and you can see a picture of the Poland facility top right there. And we are putting a pilot line in for a resource development in Massachusetts in USA. And that specific pilot line is linked to downstream evaluation for beverage cartons. So the likes of apple juice, kind of brick cartons. Resource is, in this design, the first fully recyclable beverage carton. If you buy apple juice, orange juice, or whatever, these types of cartons, they're made primarily from approximately 70% wood pulp, virgin wood pulp, and the balance being plastic and aluminium often. And the combination of these materials gives great functionality. It stops oxygen and moisture spoiling the apple juice, for example. However, it means that they're not easily recyclable, and in fact, in the UK, they're not recycled. They are primarily incinerated or sent to landfill. And globally, that's also the case. It's very difficult to separate the pulp from the plastic from the aluminium. And so they have to go to specialist recycling facilities, which are pretty energy intensive, and the output tends to be a pellet, which is used in construction applications like fence posts or whatever. So not truly recycled. Our product gives the performance and functionality using 20% of the energy, 10% of the water, and half of the global warming potential measured by CO2 emissions. It's 100% recyclable. It can be recycled back into itself and backed by our own IP. And we've developed this using MuCell technology to create bubbled layer structures in plastic, which makes it feel and perform like a paper that can be folded, printed, etc., but with the barrier properties comparable to the multi-layer structure of aluminium and plastic and paper. We are at the validation process, and it's extremely exciting, I would say. We've involved external consultants. They've been with us in many of the steps along the way, and we have contacted a large number of potential customers who, I think out of the first 50 people we contacted with brands, retailers, etc., there was only one that wasn't immediately interested, and some of them want to work with us on pilot stage. We're still at the stage for ourselves of validating this, but it is a very interesting development in a market where sustainability is key. Consumers, brands, etc., are frustrated by the existing solutions, and it's a very big market. The leader in this market is Tetra Pak. Their sales for the last year are around 8 billion euros just of the carton substrate, the material to make the cartons. So it's something we're very excited about, but still too early. It's still something we're putting money into. But this is where we are focusing the MuCell technology at the moment. So key messages: I think we've performed well, capacity's commissioned, we've got good financial strength and good opportunity pipeline. We have started 2021 strongly. There is a bit of inflationary pressure headwind. We are putting our prices up with a little bit of a lag to allow our customers to respond better and keep more or gain more business, we believe. We do see significant growth this year, and we are pretty optimistic about the future. So given that, that's the end of the presentation, and we would go to the questions. So Mark.
Yeah, that's brilliant, David. Thank you very much indeed. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated on the right-hand corner of your screen. But just while the company take a few moments to review the questions submitted already, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your Investor Meet Company dashboard, and we will send you an email to notify you when that's been completed. I'd also like to remind you that your feedback is important to the company, and immediately after this presentation has ended, you will be redirected for the opportunity to provide feedback in order that the company can better understand your views and expectations. David, Gary, obviously investors had the ability to submit questions ahead of the event. We did receive one regarding the recent I guess the recent large trade in the market that went through a week or so ago. The question reads, why did Sekisui sell its total shareholding in ZOTEFOAMS? Perhaps I could address that to you before going to the live Q&A.
Yeah, thanks, Mark. Well, Sekisui are a Japanese company who have foam operations across the globe, and in 2000 had a relationship with ZOTEFOAMS in Europe and Asia. It's a marketing arrangement, co-marketing arrangement. And at that time, they took what was termed a friendly stake in ZOTEFOAMS. That was around the early 2000s. So they've held the stake for over 15 years, and it's been diluted a little bit with equity raises over the years. They've never been an active shareholder. They've never engaged with us on presentations like this or anything to do with being a shareholder. I'm surprised they kept the stake so long. I don't have any specific information as to why they sold at this time, although they are a Japanese public company with a March year end, I believe. So I would expect that, along with many companies in industrial markets, they were impacted by COVID and felt that that cash would be better in their pockets than sitting in ZOTEFOAMS shares. That last part is my personal opinion. I've they didn't engage with me on the reason for sale or anything else. So, but the shareholders that come in all seem to be, very interested in ZOTEFOAMS. Some of them we've been meeting for quite a long time. So I'm pleased that we've got the kind of liquidity in the market from Sekisui leaving, but I haven't got any particular pluses or minuses to say about them as a shareholder. They've been very silent for 15 plus years.
Brilliant. Thank you very much indeed, David. If I could just ask you, David, Gary, if you just click on the questions tab, obviously you'll see the questions in the box there. If I could ask you to read out the question and who it's from, and where appropriate, obviously give a response, and then I'll pick up at the end.
Okay. Well, do you want to dive in, Gary? There's a few in finance and inventory.
Yeah, certainly. I think I've probably answered most of these, but let's just run through them. Inventory has changed a great deal in the set of results. Is this about storing the greater amounts that should be delivered following the year end? Can you explain the changes to depreciation? So inventory, I think I explained that. Yeah, I think somebody else spotted that or asked the same questions. I'm covering two here. Up 4.5 million. I explain why. It's also important to recognise that our strategy is about mix enrichment, moving more towards the higher value HPP products. We get higher prices for those, but they come at a higher cost. So as we grow the business, we will naturally have a higher volume of the product, and though higher value and volume. And volume is also linked not only to the fact that we're selling more, but to the fact that they are made less frequently. Our raw material for azo, for polyolefin foams, is a commodity. It is a speciality polymer when it comes to HPP, and they are not made all the time. And so we have to take care to ensure that we have sufficient safety stock to ensure that we can meet the demands of blue chip customers such as Nike and Boeing. So yes, it's going up. Can you explain the changes to depreciation? I think I did that, right? That's $1 million up, and it's very much related to the commissioning of assets. Primarily this year, in 2020's accounts, it was primarily related to the UK asset and the second line in the US, as well as the fact that the UK plant is an older plant, and so many assets are fully depreciated. As we replace them, but as a natural part of our process, they suddenly start depreciating. Do you want to go step by step, David, or should I try and cover anything finance first? Do you have a preference?
Yeah, keep going.
So if
I think you've covered two of the questions.
Well, I think I have done. Matt G asks, how did debtor days move in 2020? Everyone probably worked that one out themselves, but I've just done it, and they moved. If you purely take group sales and look at the trade receivables, they moved from 105 down to 98. There are a whole bunch of reasons why they moved down and why the number is what it is, related to mix and history and so on. That probably is a topic for another occasion. But they went down by 7 days. I think debtors and inventory were the only ones I can see finance related.
Okay, I'll pick up some of the other ones then. So first one from Simon C. What do you see the market opportunity for MuCell? And from a technology viewpoint, are there any competing technologies that's a barrier to adoption? I think NuCell is a platform technology, so actually a resource technology, although I've explained the application in the sort of Tetra Pak carton, beverage carton, we are looking at that for everything from sort of crisp bags to pouches to sachets. There's even been talk of things like toothpaste tubes, etc., all of which, you know, in the various guises suffer from the difficulty in recycling because they are ultimately barrier technologies, often metallized. So if you open a bag of crisps, you'll see kind of metallized inside to keep the crisp fresh, and that means the plastic and the metallization aren't compatible with recycling. So, you know, many things like that we are looking at. I wouldn't say there's any specific barriers to entry, but I think, or us entering the market, other than a kind of market willingness to pull the technology through. And in that sense, you know, we are competing with other solutions. As far as I can see, most of the other solutions are better than what's on the market today, but are not a complete solution. They're not an end, they're just an improvement. Whereas we offer something which is, you know, completely circular, and therefore, if it was properly managed through recycling, you would just keep doing it and keep recycling it. And so that's the sort of nirvana that we can get there. So I think we've got a great product technology. We have IP, we have patents, etc., filed around this. But I think the barriers, you know, there's so many things that you have to do with food packaging technology, testing, etc., that this is not something that can happen overnight. So we are going through a fairly robust and structured process with what we believe are the highest priority opportunities on this, but it will take a while. So I mark that from Simon answered. A question from David C. Says, over lunch in York around 3 years ago, you showed me a prototype tray, fairly translucent, that potentially provided you with a more environmentally friendly alternative to a ready meal microwave tray. That was actually something which used NuCell technology. It is something where we had some interest, but again, I think the market for that it didn't pull it sufficiently strongly enough. We have got some interest now with our resource material for tray type applications. So that's something that's progressing, and I think we are in a good place for that. I'm not sure once we do the initial trials with this customer whether it will make the top level priority list, but again, it's back to, you know, being something which is definitely better than a lot of the things on the market just now. Most or many microwave trays don't need to be barrier technology because they're frozen meals, and so we perform particularly well when there's a barrier technology needed. That's where our value is strongest. So it depends exactly on the market for that. But and no, unfortunately, I'm not at this point able to provide any customer names. But as we progress through and we go to trials, I think we have got some people who do want to be associated with this because they see their brand being associated with sustainability and want to be at the leading edge of this type of technology. And so I think if we get to late stage trials, we will be releasing some brand names, and I'm pretty sure you'll recognize them. So, question from George L. Is it possible to foam bio-based plastics? The simple answer is yes. They would foam very similarly to the existing polymers that we foam. All of our market studies tell us that there is not really a market for this. They don't want to pay a premium, and quite a deal of skepticism around bio-based because most bio-based polymers are coming at the moment from land which can be used to grow food for human consumption. So there's a bit of a trade-off there, and the industry's not quite sure. The biopolymers are more expensive as well, so it would be a premium in the market, and the research at the moment is pretty mixed on whether that's something that's sensible to do from a commercial perspective. A question from Simon C. Can you talk about any products in the HPP development pipeline? Understand if not, but given these could be the next Nike, it'd be good to understand what opportunities there are and the size of the potential. And I think I have a similar question for from Mike L. What future do you see for nylon foam? I'll take both of those at the same time. We have got so I would distinguish between products and applications. Products, we have got nylon in there. We have got the Nike type material TPE, which is being looked at for industrial applications just now, and a lot in automotive. So in terms of the scale, we've been pushing nylon opportunities for a while now, with not much success, unfortunately. And I would say there's been more action with nylon in the last 6 months in COVID than there has been in the past 6 years. We are very close to some 6-figure programs with nylon. Our operations guys have been told to get ready to ramp up. 6 figures, you know, is not really a game changer for us at this point, but the types of applications they are would imply that if they're successful, they would be very good case studies for other similar things, mainly in automotive at the moment. And same with TPE, a lot of opportunities in automotive for something which is a good energy damping, higher temperature material, performs better and is thermoformable, unlike a rubber, which can't really be shaped. So those are the types of things we're looking at, and good number of them around e-vehicles and battery technology as well. In the battery technology in particular, where they are looking for fire retardant properties in their insulation, the aircraft grades of fluoropolymer foams are also interesting. And then finally, we are looking within our fluoropolymer foams at heavier density, believe it or not, so semi-structural foams for aviation, and also at the much lighter density end, we've got some longer term R&D projects, and they are looking at things like aviation insulation. So I'll mark those as red, and I'll move on to Ed T. When will you be off exclusivity with Nike? I can't tell you that, but I can tell you I don't want to be. I think the Nike relationship is excellent. Exclusivity allows us kind of unfettered access to Nike in a way that, you know, they know that we can only supply to them, so we're completely aligned with them. And it also means that they know that they can put the marketing dollars behind the products made by ZOTEFOAMS, and no one else can have those products. So they've been very heavily promoted by Nike. And I think if we were not exclusive with Nike, we wouldn't get the access to the people in the same way, we wouldn't work collaboratively in the same way, and they wouldn't promote the foams as heavily. So I'm very pleased that the exclusivity is there, and that's kind of what we structure, how we structured it going into the agreement, believing that was the right thing, and I think actually we made the right decision there. Okay, next one from Simon C. What's a realistic timeline for resource to go from validation to sales? We actually have one licensee who is looking to move into sales in the sort of carton market later this year, but it would be very small volumes initially. We have someone else who's licensing the technology in sheet form, who is also in sales, and that's in North America. But as far as the wider carton market, it's probably, if we took Europe, for example, it's probably late next year would be the earliest that we would expect to see anything from that. But the market is huge. So Tetra Pak, who are the biggest, are 8 billion, and you know, there's a very big market there with a lot of demand, hungry demand pool. So I think I would expect that the validation needs to be done properly. This is high visibility, high risk for brands and retailers to get wrong, and we need to make sure this is done absolutely properly. We can't go in half-cocked on this, because it won't work. Okay, next question from Glenn B. What percentage capacity increase can you achieve from Poland without further major investment? The investment we've done in Poland is extrusion and foaming, and it's part of a global capacity balancing act, because we've got different stages of capacity in different places around the world, and it's not all completely balanced. But if I answer it with that sort of background caveat, it's about 20% increase, predominantly for azote products, without further investment. Next question. In the next decade, from Neil W., in the next decade, as the UK moves towards a net zero future, all energy-intensive industries will need to reduce reliance on fossil fuels and build circularity into your cross-linked products. What are your plans? Well, so there's a couple of questions in there. Firstly, I guess around cross-linked foams and you know, the ability to melt, reprocess, or recycle those. Typically, it's quite a technical area, but our foams are lighter density and use less material than competitors. So if you look at a non-cross-linked foam, they would use twice as much polymer as a cross-linked foam to get to a similar performance. And I think one of the things that we are promoting is using less material to start with. You know, once it's out there, we have a number of routes for recycling, and we're working with some people in the market. In fact, all the scrap from our customers is there are people who buy it, they're selling it, and it's been recycled into products as we speak. So, you know, the foams themselves are recycled. Although they're not typically recycled back through our own process, and there are a couple of reasons from that, mostly around the quality of the recyclate. But as the industry, the chemicals industry develops, there's a lot of companies looking at chemical recycling. So they take foams and chemically recycle them into equivalent virgin foams without coming from oil. So that's a second. Reducing reliance on fossil fuels is difficult, to be honest, for ZOTEFOAMS. We can obviously, you know, move as much as possible to green energy. And in fact, all the energy we buy now is certified renewable. The electricity we buy is certified renewable. But I think we also look at the other side of the equation, which is how much energy does the foam save, you know, in use as an insulation material or lightweighting of a vehicle. You know, that's an important part of the equation. So again, we are adopting the TCFD disclosure framework and sustainability, and we're starting to work with a lot of our customers to look at, the benefits of our materials versus other materials, and further downstream, and make sure all the information is available for the supply chain to make the right choices about what materials they want.
David, sorry to jump in, but I think you've actually taken every question that's been submitted by investors during the meeting. Obviously, mindful of time, and I know you've got a series of investor meetings today. So perhaps before I redirect investors to provide you their thoughts and expectations, I could ask you for a few words to wrap up with.
Yeah, well, just thank you for joining. We've got a lot going on. Keep your eye on the ZOTEFOAMS website, sign up for our notifications, and hopefully as we make progress on some of the opportunities or resource, etc., we will let you know progress as it happens. Thank you.
Thanks ever so much, David. Ladies and gentlemen, please, could I ask you not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback. If you access this meeting from our website, the feedback page will appear. But if you access this via the meeting, via the link sent you by email, you'll be asked just to log back in to provide your feedback. On behalf of the management team of ZOTEFOAMS, I'd like to thank you very much for attending today's presentation. That now concludes today's session. Good afternoon to you all.